market analyst at ICM.com. We chose to resume our webinar series with the topic about gold, since it was the hottest topic lately, and especially after the recent rally, which almost topped 14% at the moment. So we're going to start talking about the reasons of this rally, what are the expectations, and then we're going to show some facts on current gold holdings. Also, what big banks are expecting for gold in the coming year and to 2022, the rest 2021 and then 2022. And after that, we're going to use the MetaTrader 4 platform to do some technical analysis where we can do some projections for prices. And in the end, we're going to finish with a Q&A session. So if you have any questions, we can keep them till the end, and then we discuss so everyone can benefit from your questions. So first, I'll start my slideshow with showing the recent rally. So this is the recent rally of gold. I picked two areas. First, starting January 20, we know last year was exceptional with COVID-19 breaking, and it is strengthened starting 2020, first in China, and then it continued throughout the world. And central banks and governments just jumped in to support their economies by doing certain measures. They pumped enough money to the market where investors sold gold to benefit, and gold prices rallied to all-time high of 2072. This was the rally and was clear. And then after that, we started a sideways movement lower towards 1670 almost. We had a double bottom formation here, and then the rally started at the beginning of April. Until now, we're trading above 1900, so this is almost 14% since this bottom. You can see how steep is this rally to the upside. So we chose this rally, which is in the red box, to dissect. We're going to talk about the reasons behind this rally and whether this could be sustainable or not. What are the possible scenarios? So what are the reasons usually of investing in gold? Why do people invest in gold? Why do I want to have gold in my portfolio? So if we're talking on a bit of bigger scale, so usually investors prefer to diversify their assets. So if I have a portfolio, let's say of $100,000, I would try to allocate certain funds of this 100,000. I'll try to dissect it into different assets. So I would have stocks. I would have different types of stocks. For example, U.S. stocks, large cap and small cap. I'll have European stocks. I'll have, for example, gold. I'll have silver. So I do allocate certain funds for each asset class. So this diversification would support me in just assessing the risks. Also, people do invest in gold when we have times of high risks and high uncertainty, similarly to the ones that we enhanced last week, or last year, excuse me. So the ones that we experienced last year. So everyone was afraid of COVID-19, and we didn't know whether this is going to end, and mostly everyone was thinking that this is the end of the world. So usually during these times, the risks are very high, and people do prefer to jump in gold, which is proven historically to be a good store of value. Avoid collapse in asset value as economies fall. So most of the portfolios, they have a big portion of their funds in stocks, and usually in bad times or in deflationary moments, or even in certain occasions, economies tend to downperform, or the stock market value, for example, falls significantly. So people, in order to just avoid such, or investors, in order to avoid such collapse in value, they just jump into gold. So this is also an alternative investment to try to avoid any dip in value. Hedge against inflation. So recently, all the headlines around, like all news portals, media platforms, they're talking about inflation, what's happening with inflation, what's going to happen with inflation during the course of the year, whether it is transitory, as the Fed is talking, or it is here to stay, it is substantial. So this is what was going to shape up our webinar to the end, and I'm going to show you how inflation is affecting gold prices. So these are mainly the key reasons why do investors do want to invest in gold. I just want to clarify something, that investing in gold doesn't mean only going long on gold, or buying gold, or holding gold. So also you can, using contracts for difference or futures, you can buy gold or you can short gold. So you can, if you are assuming that gold price is going to go down, you can just open a contract and bet that the market is going to go down, and you can benefit from this. This is just if we have newcomers to the webinar. So I'm going to show here the current gold movers. Usually mine production. So the arrow to the upside is supportive. The arrow to the downside is it's not a good factor that supports upside moves in price. So it adds pressure on price. So the mine production recently is increasing. The mining production, so miners are boosting their activity, and this is just negative for gold prices. The demand is picking up for different factors, for various factors that we explained some of them in the previous slide. So this is supportive. The FOMC currently rate, the FOMC rate, the interest rates of the Federal Reserve, the Fed funds rate, they're currently stable. There is no expectation for any changes for these rates for at least 2022. So this is just a stable moment. The US dollar, the weakening of the US dollar due to different policy, the fiscal and monetary policy, the stimulus that was pumped in the markets to support the economy last year and is continuing till now, is just weakening the dollar, and this is supportive to gold. Inflation expectations are rising by the day, and this has different meanings. We're going to talk about it in the coming slide. It is also supportive for gold. As we said, gold is usually used by investors as a hedge for inflation because historically it was a good store of value. Oil prices also, as long as oil prices are on the rise, this could also raise inflation expectations, and as inflation expectations rise, investors would tend to hedge against this inflation, so they would be investing in gold. Conclusion, or the brief of all these factors, it's bullish for gold. How to invest in gold? You can either buy physical gold, you can do electronic trading. As I said, you have futures, contract for difference. All these, they're just available for you on the platforms. It's a mobile platform, computer. It is very easily accessible, where you can just trade the market. Whether you're assuming the price is going to go up or down, you can just enter in a position where you can benefit from the subsequent move. Also, gold ETFs, which are exchange-traded funds, they physically hold gold, and usually they track the performance of gold. So one of them is the GLD. So if gold goes up, and GLD goes up, and vice versa. So if gold goes down, the GLD would go down. The GLD is 10th. So if gold balance now is trading at 1900, the GLD would be around 190. Options also, there's another way to invest or speculate even on gold prices by trading options. What are the reasons behind the recent rally in prices? So first, let's start by restating what happened since 2020. So we know COVID-19 pandemic strengthened in early 2020, and the economies were mainly shut down around the world, in Asia, in Europe, in the United States. So the activity was doomed, and this definitely weighed on sentiment. Investors were pulling out of the stock market, and they just wanted something to store their value, which gold was a good player in this. Central banks and government pushed for monetary and fiscal stimulus. Monetary stimulus is when central banks, they moved interest rates towards zero, and also they went to asset purchases. They buy bonds, meaning like they're, in the simpler terms, they were printing money. Governments, they took also steps in supporting families and small businesses, and even in the United States, they went further with providing citizens with direct payments. So all these factors, all these ways that central banks and governments use to boost their economies or to support their falling economies, they just added money supply. Vaccines were introduced in late 2020. This added pressure on gold. So we were in a tunnel. Everyone was weighing the risks. The risks were high. So after that, when vaccines were introduced, we started seeing some optimism, and this optimism pulled the markets to the upside and lowered a bit the risks and the uncertainty. So investors pulled out from what we call safe haven assets, and gold is one of the traditional safe haven assets. So we had downside pressures on gold prices starting January 2021. The economic recovery picked up during the first quarter, which we saw, and gold prices tumbled significantly towards 1670. Inflation expectations skyrocketed. Commodity prices soared, especially in the United States, due to several reasons. Among these reasons were the Federal Reserve, the money pumped to the market by Biden's administration. The head of Biden's administration, we had also the money that Trump administration aligned, a couple of stimulus plans. So these all supported families, and this just also allowed some families to save money, and these savings, after the economy started to reopen with vaccination rollout, it just this money was spent, and people they started spending more and more as the economic activity is going back to normal. So all these factors, the overspending by people, the money that was saved is now being spent. It also supported inflation or raised inflation. Also, another reason why inflation is there or why prices skyrocketed is due to the failure of supply chains, especially following the restrictions that took place. So some of the supply chains, they're still disrupted, and this is just avoiding the material, mainly raw material, to just reach places, or at least if it's going to reach some places, it's going to be at a higher price. So this is also adding the prices. We have another conflict, which is the semiconductors problem. We have a chip shortage, and this chip shortage is also raising prices in different sectors. So mainly these are key factors that are raising inflation expectations. Why are we talking about inflation expectations? I'm going to show you in the coming slide. So investors do usually always focus on real interest rates. So if I want to go into an investment, I want to check if this investment is what's the real return of this investment. Real return means, like, if, for example, I'm entering in a certain investments, or I'm investing in certain asset where this asset, it just comes back with 10% annual return. However, I have an inflation rate of 8%. Thus, in the aftermath, I made only 2% return. So that's why investors do look for real interest rates, because sometimes the nominal interest rates, or the nominal returns, they look shiny. I can make 20% on an investment. However, other expenses or inflation is, for example, if it's higher than the return that I'm getting, I would be technically I'll be losing on the investment. So if an investment is yielding 5% annually and inflation is 6%, so in the aftermath I'm losing 1%. So that's why I always look for real interest rates in order to assess my investment. And real interest rates, they're usually calculated by nominal interest rates minus inflation rate, or the inflation expectation, which I'll be showing in a few. So this chart is just very simple chart, straightforward. Since 2018, we can see that gold prices started to rally since 2018, late October, where the prices were below $1,200 an ounce, to reach 2072 all-time high following the COVID outbreak. So you can see here in yellow, this is the gold price, while in red, this is the US 10-year real yields. This yield accounts for inflation. As you can see, since October 2018, the real yields were going down. Why? Because if we just go back to this explanation, we can see that nominal interest rates or nominal yields were falling back then, while inflation rate was almost sustainable. So when this goes down, and this is steady, so real interest rates were going down. What happened when COVID came in, inflation expectations currently are soaring, while nominal interest rates, they're almost steady or a little bit higher, but not as high or not increasing as much as the inflation rate or inflation expectations are increasing. Thus, real interest rates are falling. So you can see here when gold prices started, when real interest rates or real yields were a bit steady and pushing higher, gold prices went sharply lower. As gold prices started, as US 10-year real yields started to move lower again, gold prices tend to move from 1670 to almost 1900 now. Why this happened, why the US 10-year real yields dropped significantly, I'm just going to add another chart, which is the University of Michigan 1-year inflation expectations. So this is the inflation that is expected to come in a year, which is almost 4.6%. You can see it in the purple color. So as inflation skyrocketed, you can see here, this was at the bottom of gold, 1670, and this was inflation here. Earlier, the 10-year yields, I'm going to add one more chart where it explains easily what happened. So the 10-year yields were matching the inflation expectations. They were rising more than the inflation expectations. Thus, gold prices were moving sideways down. When inflation expectations jumped or soared relative to the progress of 10-year yields, we saw a recovery in gold, and investors sold gold as real yields went lower again. So this chart here, I added the 10-year nominal yields. So this is the nominal yield. It was moving higher since August. You can see the top of gold was 2072, where 10-year yields were lower. As yields moved higher, gold moved down. As inflation moved up again, gold prices moved up again, and the 10-year real yields, which account for inflation, moved lower. So what's next? What does this mean? As long as the inflation expectations will continue to move higher and the 10-year yields will continue to be trading sideways, which we're seeing for the past 2 months, gold prices could be moving higher. If inflation expectations move lower again, supply chains are back in normal activity somehow, stimulus measures, especially fiscal stimulus measures, are lessened or about to hand. This is going to also affect the consumer spending. Thus, inflation is going to move lower again, and then we're going to see gold prices moving lower again. So, what are the possible scenarios? For gold prices to extend upside rally, inflation expectations must continue to go up. Nominal yields fail to match the rise in inflation expectations. Going back to this key formula, if nominal interest rates go higher or 10-year yields move higher, when the inflation rate is steady, then the real interest rates will move higher. This is gold negative. If nominal interest rates stay steady while inflation rate moves higher, this is going to weigh on real interest rates, and gold prices will be supported. So this is the first possible scenario or this is the medium where gold prices move higher, where the Federal Reserve continuing with the same ultra-loose monetary policy, interest rates near zero, and pumping almost 120 billion to the markets every month. So this is gold supportive from the fundamental perspective. What's the alternative scenario? For gold prices to falter here and to move lower again, inflation pressures must go down. And for inflation pressures to go down, we need to see lower commodity prices again. Commodity prices, we're talking about food prices, talking about wood prices, we're talking about copper or the industrial materials. So when these prices move lower again, inflation expectations are going to move lower. Also, from another perspective, if consumers have less spending because their savings are almost lower every going forward, so this also will lower inflation pressures. Thus, as inflation pressures go down, nominal yields could stay steady, or even if nominal yields rise a little bit further, this will support the real yields, and as real yields go higher, the gold prices will move lower. Additional strong data in labor market could trigger a hawkish tone from the Federal Reserve, which would push yields higher. So what was the key reason, or what was the key argument for the Federal Reserve? The Federal Reserve recently was asked to on the markets. So in all the meetings, all the analysts, all the media reporters, they just asked Jerome Powell, the Federal Reserve Chairman, when the Federal Reserve will start tapering asset purchases. So as we said, when COVID-19 started, the Federal Reserve lowered interest rates and started a quantitative easing program of $120 billion. So the first step towards normalization of monetary policy to get out of these extraordinary measures, the Federal Reserve will start tapering asset purchases, so reducing asset purchases. The 120 billion monthly will have to drop. So when this comes, when the Federal Reserve is happy with the economic indicators, with the results on how the economy is progressing, and recently we're still seeing some slack in the labor market. So according to the Fed, there is still almost 7 to 8 million jobs lost since the pandemic, and the Federal Reserve is looking forward to just support the labor market and recover these 7 to 8 million jobs before tightening policy in a clear manner. So as long as we're seeing lower labor numbers, so this would mean that the Federal Reserve will extend the current policy path, and this will definitely weigh on yields, and this is gold supportive. When the Federal Reserve shifts in tone, and this could be reasoned by better economic data, especially in the labor market, or an upsurge, additional upsurge in inflation, this would trigger a hawkish tone from the Federal Reserve. The Federal Reserve will start declining or reducing money supply by tapering asset purchases, and this will weigh on gold prices. So these are the two possible scenarios. These are the explanations from the fundamental perspective. Now, another topic that everyone was talking about on the media, whether there is a correlation between Bitcoin and gold. This is the monthly chart for Bitcoin from April 2018. You can see how Bitcoin price and gold price were moving equally, and then both prices were higher, and then at a different era since July, prices of gold peaked and moved lower while Bitcoin peaked a month ago. So if we just want to look for a direct correlation, there is no direct correlation. If we want to move to this chart here, to the weekly chart, you can see that there is a delay between, or you can find a clear correlation between both. However, you can see that both increased in value. What could be the trigger for both assets to increase in value? This is it. You can see the 10-year yields, the 10-year real yields, the one that we use. As I said earlier, as an investor, you want to look at the real yield of your investment. So when real yields started moving lower, back in October 2018, investors started to look for alternative investments. And these alternative investments were gold and Bitcoin, which until now, they're good at storing value, since the price of gold rose by from almost $1,200 an ounce to $2,000 an ounce, while the price of Bitcoin also moved from almost $4,000 a Bitcoin towards $65,000 a Bitcoin top. So the reason behind the rally in both assets was clear: the inflation or the drop in 10-year yields. But for direct correlation between Bitcoin and gold, it's not really there. But however, there are some traders that do prefer alternative investments, and Bitcoin currently is being expected as an alternative investment, while gold is also expected as alternative investment. Some traders, some investors would prefer gold to Bitcoin, others would prefer Bitcoin to gold, and this could play in the ratio of the allocation of funds in your portfolio. So this could take, for example, if you're willing to have 10% of your portfolio as alternative investment, you can choose, for example, to have 10% in gold, or 10% in Bitcoin, or 5% in Bitcoin, 5% in gold. So choosing this ratio will create the correlation between Bitcoin and gold. Fast facts on gold holdings. So these are the ETFs, the exchange traded funds, their holdings, the physical holdings by region. So you can see that the North America has the highest holdings, 2,000 tons almost, and then followed by Europe, and then Asia and others. Also, this is the monthly change in gold ETFs holding. ETFs holding, they're usually, when gold ETFs, they go for more holding, they hold more gold, they believe that prices, or they are tilted to an exposure to the upside, where they believe they have to increase their holdings because there is higher demand on the ETFs. So when they do so, it's just more confirmation of the going trend. You can see here how the gold price is in yellow, while these bars are the ETF holdings in North America, Europe, Asia, and others. So as you can see, since January 2020, as investors rushed to gold safety, you can see ETFs increased their holdings in gold significantly during the second and third quarter of 2020, where gold prices moved after to the upside towards the peak of 2072. However, as gold prices started moving lower, recovery came underway, vaccination rollouts started, the 10-year yields started moving higher, the ETFs started unloading their gold, and we saw a couple of months of gold unloading. However, now gold, the ETFs are buying again gold. However, but they're still at a slower pace than what they did last year, where now gold prices were leading the ETFs to buy gold and not the vice versa, similarly to what happened in 2020. In 2020, ETFs holding were supportive for gold price. The ETFs were buying, those funds were buying more gold, and this drove prices of gold higher. Now gold prices are moving higher for different factors, and ETFs are trying to catch up on the train. The ETF weekly flow in tons of gold, you can see here, these were the past 2 weeks how gold, the holdings were, the flows or ETFs were buying more gold during the past week, and these are this week's purchases. So watch out for a drop in this, because it could signal that they're started to normalize their holdings. Also, another fast fact: this is gold's percentage share of total international reserves. So You can see here the one of the top share of total international reserves in the world is the Central Bank of Turkey. It's holding almost 46% of its international reserves in gold, and then Russia comes next, and then India and China. So this means that these central banks, they're holding more gold moment after moment, especially Turkey with the current depreciation of the Turkish lira. So the central bank can use this gold in order to sell it, in order to stabilize its Turkish lira. So that's why it's mainly holding, it's preferring to hold gold to other currencies in its international reserves. Also, this is another chart from the beginning of this year, from the first quarter, showing that Hungary was the top country in buying gold in the first quarter, while the Philippines was the biggest seller during the first quarter for gold. What are the big banks forecasting for gold? So this is the second quarter of 2021. The median expectations of 38 big banks forecasters is 1758, while the highest forecast is 2100 and the lowest forecast is 1650. For the third quarter, also those 38 big banks, they are expecting the median to be around 1768, while the highest forecast is 2150 and the lowest forecast is 1590. For 2021 as a whole, those banks are expecting, on average, their expectations are around $1784 per ounce, while the highest forecast out of these 42 expectations is 2100, and the lowest forecast is 1645. Going to 2022, also we have these 42 forecasters. The median forecast is 1743, while the highest forecast is 2415 and the lowest is 1350. Having a quick look at technicals before going to the MetaTrader 4 platform. So this is the MACD chart. This is since 2021. So you can see how the MACD had a crossover in March, and then the prices moved higher at the bottom. Here we had a divergence, a clear divergence in MACD, and then the prices moved higher. And until now, we have a bit of an over buying pressure with gold prices trading at 1900 and the MACD just away from the zero line. This is the Bollinger Band using 22-20 period and 2 deviation. Also, gold prices touched the upper band for a while. Now we're a bit far away. The upper band limit is at 1929. This is the RSI chart, also getting closer to the 70 area on the daily chart for gold. Also, on the 20-day simple moving average, you can see the price here. It's above the 20 and 13-day simple moving averages, just confirming the current trend. So now let's move to the MetaTrader 4 platform, and after that we're going to have where we're going to have a Q&A session. So this is the chart of gold. Starting with the weekly chart, I added the 21 exponential moving average and the 20 and the 200 exponential moving average. So we're taking 21 weeks and 200 weeks, and also the RSI 14. So previously everyone was talking about this flag or channel, you can call it whatever you want, and how the prices trade lower, and then we have this break to the upside. Also, we had another support at the bottom, which was the trend line. It was a clear trend line from the bottoms that supported gold prices at 1670, and when the prices directly touched the trend line, it started moving higher again. So in normal cases, this is just a continuation pattern that supports further appreciation and price. We're going to go to the daily chart to start dissecting some of the movement. You can see the possible targets. As long as we're still above the 21-day simple moving average, the exponential moving average, this could mean that we're still in the uptrend. The possible target, the next target is 1960, which is this year's high, and we had a couple of rejections from 1960, which could make it the next possible top resistance for gold prices. And after that, if we were able to clear above 1960, this could push the prices higher towards 2015 and then all-time high of 2070. I'd just like to remind you that this scenario should be supported with higher inflation expectation and lower yields. So as long as negative real yields are dipping into the negative territory, this could be the scenario. If inflation expectations started to ease, inflation numbers dipped, this could just raise real yields, and this could just make this scenario unvalid. So we have to always mix between the fundamentals and technicals to have a proper expectation. On the downside, if we're just looking for any movement on the downside or possible rejections or reversals, I'm just going to move to the H4 chart. It's just clearer. Also here, you can have the RSI, you can have a look. You can just draw this trend line here on the RSI that's just supported all this move to the upside. So you can see a break here on the RSI could just mean that we're starting to lose momentum on gold. Moving to the H4 chart, you can see how the price is finding good support at the 21 H4 exponential moving average. The dips to the moving average were both, and the market moved higher. Also, if we just have to draw on the RSI, you can see here this downtrend line, these divergences between the RSI and the price. So the price is moving higher while the RSI is moving lower. This could be a negative signal. And also, you can just draw this baseline here, which could be a good signal for you. If the RSI dips below this line, this could mean that momentum will started to violate the uptrend, and then you have to reconsider your choices. Also, there is a trend line here that you can monitor, so you can just draw this trend line and watch out for any pullbacks. Also, there is a line combining these stops that we've been trading on it for a while, so you can see how many times we tested this line: 1, 2, 3. The third time, the fourth, and the fifth were just rejections from this line. So watch out for a possible fifth movement to the upside, which could coincide at 1938. So these are, by using classical technicals, these are the lines or the movements that you can draw. Also, there's a trend line here by combining these recent lows where we currently today violated this line. Also, if we just move to the hourly chart, you can see how the dips towards the 200-hour exponential moving average were bought and the market moved to the upside. So watch out for any break below the 200-hour exponential moving average, because also could signal a bigger correction or violation to the trend. What could be the possible levels, the possible targets on a bigger correction? 1845 was a good resistance when the market started to move higher. So watch out for a bigger dip towards 1845, and then 1800 or 1796. The break before the last NFP release was at 1800, which also proved to be a pretty good resistance, and the market moved to the upside, had a bit of correction, and then moved higher. So watch out for these levels if you are trading or if you are looking for targets on the downside, definitely along with 1880 and 1890. These are key or minor support levels. They were previously also a noted resistance pressure and support pressure. So this area is key. 1889, a daily close below 1889 could just mean a bigger correction for gold prices, maybe towards 1845. So these are the possible scenarios for gold. We're trying to combine technicals and fundamentals in order to have a better vision on what could happen in the market. This is all for this session. If you have any questions, please write them down. And I'd just like to remind that all the information, news, analysis, and opinions mentioned in this session, they're only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. So if you have any questions, please write them down. Perfect. I believe this is it for today. If you still have any questions, you can email us at support@icm.com or webinar@icm.com, and we will be glad to help you. Can you please go back to the gold expectation chart? Okay, you mean the MetaTrader 4? Okay, if you want to note down the support zones, 1889, 1890, 1845, and 1789 on the downside. While on the upside, we have a selling pressure at 1960, 2015, and 2072. You are welcome. Perfect. I believe this is it for today. You can watch the rerun also on our YouTube channel, ICM Capital. It will be posted in a few hours. Thank you all for joining today, and wish you successful trading throughout the week.